Are we repeating 2008 again with banks just giving out loans to anyone? There has been some changes on loans backed by Fannie Mae and Freddie Mac, which seems like they are rewarding people with lower credit scores and penalizing people with higher credit scores. Is this just another money grab, or is this a way to help the affordability crisis happening in America? So let's talk about it. Before we go on, please be sure to subscribe to this channel, like this video. If you want to see more content around personal finance, the housing market, and the economy as a whole, please be sure to subscribe. All right, so here, starting May 1st, upfront fees for loans backed by Fannie Mae and Freddie Mac will be adjusted because of changes in the loan level principal adjustment fees that vary from borrower to borrower based on their credit scores, down payments, type of home, and more. They're just talking essentially that there's going to be changes happening with the closing costs, right? With that amount of money that you usually have to bring to the closing table, that's beyond just your down payment. It deals with your credit worthiness, your debt to income levels, your debt to income ratio, and things like that. In some cases, people with higher credit scores may end up paying more while those with lower scores pay less. Wait, what? How does that make sense? So essentially, you still pay less if you have low credit scores. However, the penalty now for having a lower credit score will be smaller than it was before May 1st. For example, if you have a score of 659 and borrowing 75% of a home's value, you'll pay a fee equal to 1.5% of the loan balance. Before these changes, you would have to pay 2.75. Now, if your credit score is higher at 740 or higher, you used to have to pay 0.25% fee for that same loan, but now you could pay as much as 0.375 for that loan. So essentially, yes, you do pay less than someone with a lower credit score. However, the amount you pay is increasing for someone with a higher credit score. Now, first of all, I don't want to bash like people in their situation because, when I started off, I had a low credit score because I was young and I didn't have a lot of credit history. And so I had to navigate and learn how to get a better credit score and just learn the whole process of it. So I can understand what they're doing here. I see it as good in some situations because let's say some people just made mistakes and now they're trying to turn their life around and trying to improve, trying to buy themselves a home, or for whatever reason, like this is actually a good thing in my opinion that they don't have to pay as much fees. The thing that I disagree with is that it seems like some of these costs, or since they're not getting as much money from people with lower credit score, they're offsetting that cost on people with higher credit scores. Now people with higher credit scores have to pay a little bit more because they're not taking as much revenue, or they're not getting as much revenue from people with lower credit scores. And so it seems like you're giving discounts to people with lower credit scores, but you're not giving discounts to people in general, like overall. It does rub people the wrong way, which I understand, but I just want to take a non-biased view just to put it out there. But I do see people's concern for this. And I think another interesting to point out is that maybe they are truly offsetting the cost, because usually people with higher credit scores, I would guess the majority of people that buy expensive homes have higher credit scores, right? They have good salaries, their debt to income ratio is pretty low, and they probably pay everything on time because they have the income to support that. And so they have a higher credit score. Their fees are increasing. These fees are based on the loan value. So people with lower credit score, they may get like a $200,000 house that they have to pay 1.5% on that loan. But let's say someone is buying $1 million home and they now have to pay a little bit higher, or $2 million or a $5 million loan. Now, since that loan is so large, they may end up paying way more money, or even offsetting and helping Fannie Mae and Freddie Mac pay off the discounts they've been giving to other people. Now, just to run some numbers, just for kicks and giggles, let's say you have an $100,000 house. Before, if you had a lower credit score, you would pay around 2.75% of that fee. So that will be $2,750. But now you only have to pay $1,500. So because it's only 1.5%, which is pretty good. And so for most people, that's a difference of about $1,250. Because if you do the $2,750 minus the $1,500 that you now pay, the discount is $1,250. Okay, And just to break that down a little bit more, let's say you get a loan for $100,000 to buy a house. If you had a lower credit score, you would have to pay 2.75% of that loan. 2.75% of 100,000 is $2,750. That was before. That's happening right now before May 1st of this year. But after May 1st of this year, if you have a credit score lower than 659, you're now going to be paying $1,500. So just to show the difference, before people were paying $2,750 of fees, but now they're paying $1,500. So that difference is $1,250 for that consumer, which is a pretty good discount. Honestly, saving $1,250 on every $100,000 that you take if you have a lower credit score is pretty nice. Now let's look at a higher credit score. Someone with a credit score of 740 or more may not pay $100,000 for a house. Maybe they're living in a decent area or for whatever reason, but I just want to see just like a high number. So let's go to $1 million. So if we go to $1 million and we multiply it by the fee that it is right now, which is 0.25, that is 0.0025%, that's $2,500 they pay right now before May 1st. But now with these new changes happening, the fee is 0.375, right? And $1 million times 0.375% is $3,750. And so in order to offset that cost, Fannie Mae and Freddie Mac, they have to sell these $1 million loans, which they may or may not do to people. And because if you take $30,750 minus $2,500, that's the difference of $1,250 that they're making, which will offset every $100,000 that they're giving to someone with a lower credit score in order to offset that cost. I hope that makes sense. That was a lot of different numbers, but I hope that was a good visualization for it. And this is big in the industry because Fannie Mae and Freddie Mac, they share the mortgage market comprised of nearly 60% of all new mortgages during the pandemic. Now, and that's up from 42% in 2019. Why are they doing this? They're doing this for equitable and sustainable access to home ownership. You know, they're just trying to make it more affordable for different people in different backgrounds and whatnot. Groups that benefit from these changes are low to medium income first-time home buyers. And I think that's fine. You know, I think that's okay to have some sort of discount so they don't have to pay as much because of the economy, because of what's happening with everything. But I understand people's, drawback to people with higher credit scores, or it seems like they were the responsible ones, so to say. But not really. People with low credit scores can be super responsible, and people with higher credit scores can be really irresponsible. So let's just say that. But for the most part, it's just, people think that way, right? People think that in a way they're penalizing responsible people, right? They're charging them more and rewarding people that are less responsible. Buyers using a home ready, home possible, and even some of you are watching this video, you're probably here at the stage where you had to get these type of loan products because you weren't there yet and you built your business and now you're over 740 credit score and you can maybe pay cash for your house. So I'm just trying to see both sides to the argument and not pick one side. But yeah, it's aimed to these people, low income buyers, the HFA Advantage, HFA Preferred loans offered through state and local housing finance agencies, and single family loans that fall under the Duty to Serve program that helps low and moderate income families finance manufactured housing and rural housing purchases. All right, let me know your thoughts down below. With higher interest rates and higher home prices are still elevated. Actually, for the past month, the month of February, home prices actually increased according to the S&P price chiller, this index that's super accurate that a lot of experts use in order to see the changes in home price. They just showed an increase in February compared to January. And so home prices are still rising. Yes, not at the same rate as they did last year, but they're still rising. They're still super elevated. And on top of that, we have higher interest rates. And so now people who have a higher credit score are paying even more for their property because of these higher interest rates. Now they have to put down even more money for closing costs and things of that nature. Let me know your thoughts down below. Please be sure to subscribe, like this video, and I'll talk to you all later.